Those who are worried about tonight's CPI crash in the market actually have little understanding of what CPI really is. The current tape correction is simply the market falling into collective pre-data anxiety ahead of the CPI release. In reality, the recent surge in oil prices has already been fully priced into CPI expectations. It will be very difficult for tonight's data to actually exceed those expectations. Therefore, I actually believe there is no need to panic excessively at this moment. What is the true nature of last night's US stock market correction? It wasn't a collapse of the AI narrative. It wasn't a crack in the fundamentals. It was simply a normal bout of high level profit taking. Let me share a data point with you. From January 28th to March 30th of this year, the Nasdaq 100 dropped 12.8%, which took exactly 2 months. This time, dropping from June 3rd to June 9th, it fell 8.4% in just 6 trading days. This is a classic case of trading press for time. The magnitude of the drop is relatively limited, but the velocity is incredibly fast. The decline was magnified primarily by forced liquidations of leverage accounts, coupled with a liquidity drain from SpaceX. However, this type of rapid plunge usually doesn't last long because throughout last night's session, sector rotation was constantly in play. Tech and semiconductors were bleeding, but the Russo 2000 small caps bucked the trend, rising 0.23%. Real estate, financials, and materials rally across the board. The market's overall advance decline ratio was 3,500 to 2,800, and capital didn't flee the US market. It merely rotated out of heavily extended tech stocks and sought refuge in defensive sector. So this is not a bear market signal, but rather a high to low capital rotation. Let's cut to the chase with gold. Breaking below 4,200 in today's Asia session is now just a paper-thin margin away from the 3,000 level I previously warned about. The pendulum tracking was nearly maxed out. Even notorious promoable influencers are suffering public meltdowns, trashing gold as garbage. Behind the scenes, this raw emotional capitulation is precisely the hallmark of a structural button. The irony? The exact same retail crowd who FOMO bought at a peak earlier this year are the ones desperately slashing their positions today. Institutional sharks love to explore this exact moment, weaponizing the narrative to squeeze the weekends out of the market. And look at the orchestrated media bleeds. Headlines screaming about Citi downgrading gold's short-term target to 4,000. And yet they conveniently downplay the reality that Citi quietly maintains a year-end bullish target of 5,000. It's a classic shakeout. Back to the tape. The herd is terrified tonight CPI will hammer gold, but as I outlined earlier, extreme passionism regarding the CPI is already fully present. The tape is set. The moment the data merely meets or slightly misses expectations, a vicious short covering rally will ignite. The darker the pre-data sentiment, the more violently gold will slingshot upward once the bad news is exhausted. Make no mistakes, though. Even with a reflexive bounce, gold's short-term structure remains firmly bearish. Do not lose sight of that reality. Some might be tempted to catch the falling knife and go long, but I see zero confirmed button signals. Smart money play is fading the intraday bounces. I'm eyeing 4,350 for short entries with a hard stop at 4,400 and no setup, no trade. I would gladly sit on my hands. And furthermore, aggressively chasing short at 4,200 is the fool's errand. If CPI prints a bullish or even neutral, an instant upside liquidation week will wipe out the lead to the party bears. And finally, let's talk about crude oil. Another massive plunge occurred during today's Asia session. The catalyst was Trump stating yesterday that negotiations with Iran have entered the final stages, with an agreement expected within 2 to 3 days. Whether it actually goes through this time is anyone's guess. However, statistics show that Trump has claimed a deal is imminent over 30 times to date, with a fulfillment rate of absolutely zero. Okay, let's run a strat test. Assuming a deal is actually reached this time, where does crude go next? I will make a bold prediction. Oil price would initially dive to find a button, and inevitable release of panic sentiment, but the script will flee rapidly because when the strait truly opens, the market will be sharp to realize that a 3-month supply disruption has left crude inventories near rock bottom, coupled with global buyers initiating preemptive restocking to hedge against similar crisis. This will lead to a period of severe supply deficit, driving oil prices up swiftly. And therefore, in the face of this headline-driven volatility, bulls can patiently wait for the golden pit. The deeper the smash now, the more vicious subsequent retaliatory rebound will be, fueled by the profound supply-demand mismatch. As always, this is just my personal analysis, not financial advice. And also, shout out to EBC Financial Group for sponsoring the content. Bye bye.